Investing in mutual funds is a simple and effective way to grow your money by pooling your funds with other investors to buy a diversified portfolio of assets. A mutual fund is managed by a professional fund manager who selects and manages investments such as stocks, bonds, or other securities based on the fund's objective. This makes mutual funds accessible to both beginners and experienced investors who want to diversify their portfolios without picking individual investments themselves. There are different types of mutual funds, each designed to meet specific financial goals. Equity mutual funds invest primarily in stocks and aim for long-term growth. For example, if you invest in an equity mutual fund focused on technology companies, the fund manager selects a mix of tech stocks to maximize returns. Bond mutual funds focus on fixed income securities, such as government or corporate bonds, providing steady income with lower risk. Balanced mutual funds combine stocks and bonds, offering a mix of growth and stability. Additionally, index funds, a type of mutual fund, track the performance of a specific market index, like the S&P 500, providing a cost-effective way to invest in the broader market. Investing in mutual funds offers several benefits. Diversification is one of the biggest advantages, as mutual funds invest in a wide range of assets, reducing the risk of significant losses from any single investment. For example, instead of buying shares in just one or two companies, a mutual fund might hold dozens or even hundreds of different stocks or bonds. This spreads risk across multiple sectors and assets. Professional management is another benefit, as fund managers use their expertise to make investment decisions, saving you time and effort. Mutual funds are also highly liquid, meaning you can buy or sell your shares at the end of each trading day at the fund's net asset value, NAV. However, mutual funds come with costs, including expense ratios and sometimes sales charges loads. The expense ratio is an annual fee expressed as a percentage of your investment, covering management and operational costs. For example, a fund with a 1% expense ratio charges $10 annually for every $1,000 invested. Some funds also charge front-end or back-end loads, which are fees for buying or selling shares. It's important to understand these costs, as they can impact your overall returns. To get started with mutual funds, you can open an account with an investment platform, brokerage, or directly through a mutual fund company. Many funds have low minimum investment requirements, making them accessible to a wide range of investors. For instance, you might start with as little as $500 or even $100 in some cases. You can choose to invest a lump sum or set up regular contributions, such as monthly investments, through an automatic savings plan. Mutual funds are often used for achieving long-term financial goals, such as retirement or saving for a child's education. For example, if you invest $10,000 in a mutual fund with an average annual return of 7%, your investment could grow to nearly $20,000 in 10 years, assuming the returns are reinvested. Over time, the power of compounding helps your money grow faster.